So this is a great example of that active point, because if you think about what the US market represents, it's combined, I mean, 500 different stocks in the S&P 500, right? All in different sectors. About 30% of the US market is in technology, where you see some of the most elevated valuations and where you've seen some of the most aggressive selling pressure so far this year, given the sensitivity of technology stocks in particular to the potential for higher interest rates. So do I think US markets are in a super bubble, to the question? No, I don't, at a broad level. I think there are pockets in the market where valuations are very expensive. I think there are other parts of the market. So take US banks, if I'm allowed to call that out, despite working for a US bank. That's a sector that's not expensive relative to history and is actually going to fare a lot better in a rising rate environment. Banks generally become more profitable as interest rates go up. So I think it's a great example of why perhaps today, if you are adding to the US market, maybe you don't want to buy everything there, given that that's naturally going to give you a really big slug of technology and growth where those valuations are really high, but you can still find opportunities underneath the surface of the index in some of the sectors that still have more room for catch up and are perhaps better suited to the kind of economic environment that we expect.